Despite the challenges and risks of investing in China, many of America's billionaire investors are forging ahead with investments in the country with a damn the torpedoes attitude. One of the main reasons for this is the potential for high returns on investment in China. The country's economy has been growing at a rapid pace in recent years, and the country has made significant investments in infrastructure and in technology, which has helped to attract foreign investment. Additionally, China's large population and rapidly growing middle class make it a highly attractive consumer market for a wide range of products and services. Another reason for the bullish attitude of America's billionaire investors towards China is the growing interconnectedness of the global economy. As China's economy continues to grow, it is becoming increasingly integrated with the rest of the world, and many investors see opportunities to tap into this growth by investing in China. However, it's important to note that investing in China also comes with its own set of challenges and risks. Among them, regulatory uncertainties, the lack of transparency, currency fluctuations, and political risks. Despite these challenges, many of America's billionaire investors are taking a long-term view and betting that the potential rewards outweigh the risks. They are investing in a wide range of sectors, from technology and e-commerce to real estate and infrastructure. Moreover, some of these investors are also finding ways to mitigate these risks by forming partnerships with local companies, taking advantage of government incentives, and diversifying their investments across different sectors and regions. In conclusion, America's billionaire investors are going full speed ahead in China, despite the challenges and risks, seeing the potential for high returns on investments in the long run. This approach may be seen as a bold move, but it's important to remember that these investors are experts in evaluating the risk and reward of the investment opportunities. Howard Marks, a billionaire investor and founder of Oak Tree Capital Management, has recently spoken about the potential risks and challenges of investing in China and the importance of being selective and strategic when making investment decisions in the country. First, let's take a look at why China is such an attractive market for investors. With a population of over 1.4 billion people and a rapidly growing middle class, China has the potential to be a major consumer market for a wide range of products and services. In addition, China's economy has been growing at a rapid pace in recent years, and the country has made significant investments in infrastructure and technology, which has helped attract foreign investment. However, as Howard Marks has pointed out, there are also significant risks and challenges associated with investing in China. One of the main concerns is the lack of transparency and regulatory oversight in the country. This can make it difficult for investors to accurately assess the risks and potential returns of their investments. Additionally, there are concerns about the potential for currency devaluation and economic instability in China, which could lead to significant losses for investors. Another challenge that Howard Marks has highlighted is the difficulty of navigating the complex political and economic landscape in China. The country's government plays a significant role in the economy and has the power to make changes that can have major impact on the success or failure of an investment. As such, it's important for investors to have a deep understanding of the political and economic climate in China in order to make informed investment decisions. In addition, Howard Marks also suggests that investors should be careful about where they invest in China. While certain sectors, such as technology and e-commerce, have the potential to be highly profitable, other sectors, such as heavy industry and state-owned enterprises, may be more risky. Ray Dalio has spent 30 years managing money for Chinese clients. He isn't going to stop right now. Howard Marks, a billionaire, advises being selective when choosing where to invest in China, yet he won't be moving. Just this year, the world's largest asset management, BlackRock, led by billionaire Larry Fink, introduced a number of mutual funds specifically targeted at Chinese clients. He doesn't intend to make a U-turn. Famous rich American investors aren't changing their minds about China, with a few notable exceptions. Nothing seems to be able to change it. Not the COVID-19 lockdown, not the protests against the lockdowns, not the Chinese government's response to the protests, not the genocide of the Muslim Uyghurs, not the use of slave labor in Xinjiang, not any stock fraud involving Chinese companies, not the crackdown on democracy in Hong Kong, not the 30% drop in the Hang Seng since 2019, not the ongoing theft of intellectual property by Chinese firms, and not US. According to Jim Rogers, the renowned international investor who essentially wrote the book on investing in China, China is still going to be the most successful country in the 21st century. America was the most prosperous nation in the 20th century, but we also experienced a lot of terrible things. Even so, we were successful. You would have lost a lot of money if you had given up on America. Ignore the reality that President Xi Jinping leads a totalitarian regime in China, whereas the US still conducts meaningful elections and has a system of checks and balances that should help to limit the influence of any one faction. Many wealthy investors are unwilling to withdraw from the process because China provides cheaper labor, a ruling class hungry for economic growth, and the hope that 1.4 billion Chinese citizens will become an army of consumers. For its third China fund, Dalio's Bridgewater raised $1.25 billion in November 2021. Bridgewater has been managing private funds in China since 2018, with its first one, according to the Wall Street Journal, predicting a 19% annualized return through 2021. Bridgewater ranked among the top international managers of private funds in China as a result of the fundraise. The rise was only the most recent in Bridgewater's relationship with China. Bloomberg revealed in 2017 that one of Bridgewater's top clients is the Chinese government. China has been a client of Dalio's company since 1993, according to the report. About $5 billion of the state's assets were managed by the hedge fund as of the previous year. Bridgewater and Dalio declined to make any additional comments. Another important update is that markets immediately reacted favorably to China's long-awaited removal of COVID-0 rules in December, and subsequent reopening to the rest of the world earlier this month, which gave investors faith that China was once again open for business. However, not everyone believes that China's reopening is good for the world economy, and some fear that it may even increase global inflation. China has been largely cut off from the world economy for the past 3 years, with leaders literally leaving the nation and new immigrants being subject to stringent quarantine, immunization, and testing rules. Supply chains were damaged by frequent lockdowns in China's manufacturing centers and backlogs at port cities, which raised concerns about global inflation. However, such times may be ended as citywide lockdowns are no longer common, and large-scale spending Chinese travelers are slowly returning to the outside world. Vice Premier Liu He will be attending the World Economic Forum in Davos, Switzerland, this week. Even Chinese leaders are going once more. In a speech on Tuesday, Liu predicted that this year will see China's economy return to its normal trajectory, with rises in imports, investments, and consumption. A windfall to the world economy, which the IMF and the World Bank have both warned it perilously near to entering a recession. The head of the biggest wealth funds in the world cautioned that the world should be wary of China's reopening because it might lead to a fresh wave of international inflation. In a Wednesday interview in Davos with Bloomberg, Nicolai Tangen, the head of Norway's $1.3 trillion sovereign wealth fund, said, "I think the huge major unknown this year is what will happen with global inflation when China steps in. I think it will be inflationary, and there is a chance that on the back of that, we may see an acceleration of inflation again. That would be incredibly horrible for markets," the author said. According to Tangen, if China's internal demand for commodities builds up steam, the reopening could be a surprise to global markets, with energy prices being most at risk. S&P predicted last month that the reopening of China will lead to an increase in energy demand of 3.3 million barrels of oil per day this year, or roughly half of the projected growth in global energy demand in 2023. With that, the video has come to an end. Let us know what you think in the comment section to help us expand our community and attract more people who share our interests and are eager to learn. Please hit the like button and subscribe if you thought the video was interesting. Till then, bye.